trading session. 900 up, 800 lower. So even in terms of, if you look at advanced decline, and this is very early to do that, there's not very much which one can kind of say one way or the other. Max Health on one side. I think with Max as well, there's a call from one of the brokers. BEL is there, JSW Steel, so they're all green. And on the other end of the spectrum, there's Indigo, Wipro, Nestle, but split right down the middle on the Nifty heat map. 24 points lower at this stage, 25,940 on the index. Guys.
Well, let's talk about Max Healthcare, where Citi has written a note where bullish call 1460 is the target price, and the current market price is about 1165. Max Healthcare is up 1%, top gainer now on the Nifty. They met the management, that's Citi, and the key takeaway is that the management expects a strong growth trajectory supported by rising occupancy, improving case mix, improving profitability at Dwarka and Noida, and even the three major brownfield projects which are going to be commissioned, they don't expect an EBITDA drag from there. So Dr. Reddy's is doing pretty well. BEL has seen a pop this morning. The company has gotten into a joint venture agreement with another company, Safran Electronics, for production of Hammer Smart Precision Guided weapons. So joint venture agreement, BEL, has seen a bit of a pop. Other gainers included Dr. Reddy's. Dr. Reddy's today has surpassed the 200-day moving average with the gain today. The European Commission has granted marketing authorization for a medicine for Dr. Reddy's, which is used to treat osteoporosis. So news there, and stock is doing well. So the top three gainers are Dr. Reddy's, BEL, Max Healthcare. Other stocks on the gaining list include Maruti Suzuki, Bajaj Auto. Eternal is up close to about 0.5%. JSW has a little bit of a green tick. On the way down, IT is seeing a little bit of profit booking after yesterday's gains. So Wipro, Infosys, Tech Mahindra in the red. Nestle has a bit of a downtick. Reliance Industries, JP Morgan is bullish. They see the target price above 1700, but there is no rub-off this morning. Reliance Industries is a bit subdued. And let's just pull up some of these oil marketing companies to see if there is any impact of that Investec downgrade. BPCL, HPCL, IOC come up for you on your screen. 1% down.
Well, that's right. And in fact, the Nifty is down 25 points thereabouts. I think the Nifty has very, very strong support at around the 20 DMA. So in all probability, that doesn't get breached in today's trading session. But the breadth of the market is already negative. So that's a bit of a worry. And by the end of today, if that can turn around, the bulls will feel very, very good, because on a day-to-day basis, we have seen the number of stocks that are declining are outweighing the number of stocks that are advancing. Moving to individual stocks, ITI has given up some ground, fallen on decent volumes for the first few minutes, down 2%. RVNL is another one. I think yesterday in late trade, it did see a bit of a surge. That one's giving back some part of it. It is down close to around 1.5%. And Aztec, Aztec Life, I think we should get that stock up for you on the screen. It was down a little bit. It was down 3% actually, but that dip has got bought into. And on a day-to-day basis, I've been observing this on Aztec. The last 1 month, it is up close to around 35%. So that's a stock that should be on your radar. Karnataka Bank, another one of those big movers. Large amount of the stake is with institutions. There are large HNIs as well that have it. And on a day-to-day basis, volumes have been very, very high. That is up yet again 2.5%. Grow, that's up close to around 3%. Remember, in yesterday's trading session, the stock slipped considerably from the highs. So that started off at least on the winning side. And I think Physicswala as well, there was some green to kickstart trade. So the Nifty is holding with mild green now, 10-15 points higher. However, the breadth of the market, that's important. And for the time being at least, number of stocks advancing are marginally outperforming the number of stocks declining.
Absolutely, Nigel. By the way, Grow at 157 rupees is the number one volume-led gainer by far. Huge volumes on it, and it's up about 3.5% at this stage. This is GE Vernova TND, right? 1%, but very large volumes. So keep an eye out on this one. Karnataka Bank, big outperformer. I mean, it just keeps going. So 2 days back, 175 close, 200 pass now. So that's the other thing. What else? Teamlease was this big shooting star, but Teamlease kind of ended in the middle of the range. Yes. The high yesterday was about 1872, and the close was 1686. But it's up 3% this morning. Premier Explosives 1.7 higher. There've been a couple of upgrades on these new listings, HDB and Tata Capital. HDB I can see with about 1.5% gain. LG Electronics, again, one of those names after listings which has not done very well. It's up about 1.5%. The Phoenix Limited, the mall company, 2% higher. And so it goes. But, you go down the list, volumes start to thin out very, very fast right away. Narayana Hrudayalaya, basically, it's a big step up compared to where it was, 6-7 days back. From 1750 levels, it went up to about 2100 and it's cooled off to about 1940 right now. It's under pressure with some, not large, but it's got volumes on it. Swiggy is down another 2.5%. Swiggy is down, 2.5 odd percent at this stage. So, I mean, it's a quiet, very, very quiet. 1 point change on the Nifty, right? 25,955, so finely balanced almost. Well, we have Ashish Gupta, CIO at Axis AMC, is with us. Ashish, good morning. Great to have you with us here. Prashant this side. Thanks very much. As some people have jokingly described it, but I think the description fits accurately. This is a market in liquid oxygen. That old Ajit saying, "Jeene nahi dega, marne nahi dega." It's like there's enough on both sides, right?
I agree with the sentiment. I think if you look technically on the market, you have the macros that support it. I think we are also seeing a fair degree of resilience in earnings. I think this quarter, after nearly 5 quarters, we have kind of stepped away from the earnings downgrades that we had been witnessing. So I think the macros support the market, domestic flows support the market. But on the flip side, we continue to have the challenge with the large pipeline of IPOs and stake sales, right? And if you look at the data, just in the last 90 days, more than 60,000 crores of IPOs have happened. Over the next 1 month itself, another 30,000 crores of IPOs are slated to come to the market. So I think the fact that domestic flows and SIP flows continue to be strong is offset by this continuous supply that we are seeing. And again, IPOs is only one part of the supply. And if you see some of the data about non-IPO supply, so for example, companies that had IPO'd in the last 6 months, about $30 billion of stakes will be getting out of lock-in over the next 6 months. So unfortunately, this pipeline of supply does not seem to be abating anytime soon, and that kind of keeps the market upside more moderate.
I think sometime this week we'll hear more on Misho's IPO too. Perhaps the price band and then the opening would subsequently follow. And that's going to be a big one, keenly tracked. Ashish, morning. This is Rima here. So as you look ahead to 2026, what are the big predictions that you are making? What do you expect? India's performance relative to global peers, will it reverse the underperformance? I mean, what are your thoughts about next year? And give us your top 3 predictions.
Sure. So I think clearly this year, thankfully, on absolute basis, India has not done too badly. We are still up a high single-digit percentage, particularly in the Nifty. The broader market, the small caps may not have done as well. But I think it's not been a bad year for the overall market. We'll end the year on a positive note. Where we kind of have struggled is on a relative basis. This has been a year of global equity market rally, particularly with the dollar weakness in the beginning of the year. Many global markets have been up in dollar terms between 25 to 35%, and we have not participated in that. Looking at next year, I think we can be more confident in saying that relative underperformance should go away. I think the challenge will be what's the degree of absolute outperformance that we will have, because given where valuations are, given the magnitude of supply that is coming in, big gains in the market look unlikely. I think what is very positive for the market is that in the last 6 to 9 months, we have seen a lot more affirmative action from the regulators, RBI, SEBI, as well as the government. And I think really we, after the challenges we have had on the tariff front, there is much more a sense of urgency in the government to take action to support the economy. We have seen reforms on the GST side, more recently on the labor code. We are going to see in the next month and a half the new insurance bill coming through the parliament. There are more capital market reforms that are on the anvil. And another big activity that is being undertaken is deregulation. So there is a committee headed by the cabinet secretary that's driving this. There are also several provisions around decriminalization of major laws that are coming through. So I think that is really what will continue to spur the economy over the next 6 months. And that makes us more optimistic that the earnings recovery that we are seeing should sustain into next year.
All right. Hi, Ashish. Good morning. Good to see you. And Nigel on this side. Ashish, I wanted to ask you about the RBI action. What's your take? December rate cut is something that the street was expecting. You suddenly had some weakness on Friday, on the Indian rupee, which, gave you a little bit of a jitter. But otherwise, inflation down. I think the CAD is at the lowest we've seen in multiple years. Do you think that a rate cut is in the offing? Would you be backing it?
Yes, I think definitely we are expecting a rate cut. I think, frankly, if the pressure on the currency would not have been there, I think the probability of even a 50 basis point rate cut would have been there. But I think 25 basis point rate cut probability in the December meeting continues to be high despite whatever recent volatility on the currency we have seen. I think where we need to kind of be watchful of really what is the RBI action on the liquidity front. And if some of the defense of the currency leads to some moderation in the liquidity surplus that has been there in the market. If we look over the last 3 months, unlike last year when RBI tried to defend the currency around 83, 84 levels, the intervention has not drained out liquidity, and that's meant that cost of funding has continued to drop. So I think that is the only piece that we need to watch out for, that even as rates come down, even as RBI kind of steps to curb the volatility in the currency, how does the liquidity environment pan out? The other piece is really in terms of the demand supply for the long duration bonds. I think while liquidity has come in through the CRR cut, this year the open market operations have been limited. And the demand supply of bonds, therefore, has not been as favorable. And that's the reason we haven't seen the drop in the 10-year yields commensurate with the magnitude of rate cuts that have happened. So I think these are the two points that we need to watch out in the policy statement. I think the market is fairly confident about the rate cut coming through.
Ashish, we've got a flash running attributed to you. Big gains in markets unlikely. But we need some gains. Where will those gains come from? Where, would you look to, would one have to venture into slightly more, for the lack of a better word, riskier areas of the market, more, focused on absolute returns, single stocks, and even within sectors which look like they're not going anywhere? So what's the strategy going to be at Axis?
Yeah. So actually, we are seeing over the last quarter, earnings growth recover and coming back even in the large cap space. Right? And if you see last 5-6 quarter, the gap between earnings growth between the mid cap and the large cap space had widened. Large cap earnings growth had come down to low single digit 5-6%. And as I look into the next year, you are actually seeing large cap earnings growth recover It's recovering in financials. It's recovering in the energy sector. Most of the IT companies are also talking about revenue growth being better than the last 12 months. And we are actually seeing next year earnings growth moving to about 15 to 16%. If you would have seen 3 quarters ago, we were at about 6% earnings growth. This quarter, earnings growth for the market has recovered to 10%. But clearly, the large cap earnings growth is picking up, and it's broad-based. If I talk about sectors, of course, financials, both banks and NBFCs, we continue to like. Besides the liquidity, what we are seeing is some early signs of pickup in credit. Asset quality challenges have anyway been modest. We continue to like sectors like power, defense, where there is strong themes of indigenization also playing through. Consumer discretionary is another area we like. So there are multiple sectors to go play. And I think it's going to be a better market than what we saw, say, beginning of this calendar year, where the gains were much narrower.
All right, Ashish, always a pleasure talking to you. Thanks a lot for joining in. Wishing you a good day ahead, and we catch up before the end of this calendar year. Thanks a lot for joining in. Well, let's turn our attention now to the ferrous space, and there's plenty happening, both on the domestic steel industry as well as on the global front, with China exports continuing to remain at elevated levels. How can our regulators, as well as the people at the center, protect the domestic steel industry? Well, to help us out with some clarity, we have Sandeep Pondrik, the Secretary, Ministry of Steel, who joins in. Hi, Mr. Pondrik. Good morning. Thanks a lot for joining in. Always good to have you on the show, sir. Now, Street is waiting to hear from you, sir, because there have been some jitters with regard to this protection that you all were offering to the ferrous industry. Case in point being the safeguard duty. You all put it in at the right time. Then there was that notification that said that it's going to be in the works. However, the safeguard duty lapsed earlier in November, and there were some jitters about the way ahead. Is it delayed, the final notification, or is there some rethink? And if there's no rethink, by when do we expect this final notification with regard to safeguard duty on steel?
So thank you first for having me on the show. And on the safeguard duty, as you know that there is a process which was conducted by DGTR. And on the recommendation of DGTR, the provisional duty was imposed, which was effective till early November, 6th, 7th November. After that, the provisional duty has lapsed. However, DGTR has also recommended a safeguard duty for 3 years, which is under consideration with the government. So we can expect a decision pretty soon. I can't give you a time frame right now, but I will expect a decision of the government in the near future.
All right.
That's the best I can tell you.
All right, so Mr. Pondrik, basically you're telling us that but currently is the safeguard duty already in works, that 12%?
No, after the provisional duty has elapsed, the safeguard duty is no longer there for the intervening period. If the government decides to reimpose it, means as per the DGTR final recommendations, then it will come into picture again.
But is there a risk, sir, that it doesn't, because in all probability, my interactions as well, whether I spoke to Tata Steel, JSW Steel, all of them indicated that it's coming. Just it could be a delay. It's not being put on the back burner. It's just a delay. Should we term it as a delay and we'll hear about it in the coming weeks?
As I said, the government decision should be there pretty soon. That's the best I can tell you. You know that since the matter is under examination in the government, I can't really give you a time frame or what the decision will be, but the decision should be there pretty soon.
Okay, we'll take it as pretty soon then, and the ferrous industry will be hoping sooner, not just soon, because otherwise we are at the risk of those imports coming in there. And the other point is, India relaxed the quality control regulations on steel imports. Why be diluting BIS, sir? Do we have some kind of change in policy to facilitate maybe imports to help the SME players? Is there something on that front? I want to know the thought process.
So basically, before answering your question on quality control orders and BIS standards, I would like to point out the status of imports and exports.
Yes.
Now, if you actually see the import-export data vis-a-vis the data of the last year, the situation is much better in terms of trade imbalance as compared to last year. Last year, if you take the April to October data on steel exports and imports, last year the exports were less than half of imports, while this year they are more or less same. Imports are still slightly higher, but the situation is much better. Overall, the imports have reduced by 34%, and exports have increased by 25%. So just to give the background that in terms of trade imbalance in finished steel, the situation is much better than last year. Now coming to the issue of quality control orders and BIS standards. So there was a high-level committee made by the government which has recommended certain measures to ensure that the export competitiveness and the efficiency of domestic market is maintained. Now, when we talk about domestic market, it includes both the steel producers as well as the steel consumers. So the idea is that the domestic consumer industry also gets steel at a reasonable price, and they are not adversely affected. So that's why there have been decisions to relax some quality control orders on BIS standards for a specific time. So for some standards, we have relaxed it, suspended the QCO for 3 years. For some, we have suspended the QCO for 1 year. It's also, for example, that in specialty steel, since we don't have production in certain grades, and specialty grades have to be imported, so we have suspended the QCO for a year. And we hope that the domestic capacity will come by that time. So it's basically to balance the interests of both steel industry and the consumer industry both.
Okay, you're trying to do that balancing act in there. And Mr. Pondrik, in the past you have said that India's per capita of steel will just move up from here on. I think we're ballpark around 105 kgs or thereabouts. And you said that, we're likely to head to around 140, 150 as well. So how are you seeing demand on ground? The growth has been very good. Steel consumption growth in India actually has been splendid if you compare it with the globe. Do you expect demand to continue at this sort of a pace, 8-9% kind of growth? And also the government may go easy on the capex, right, in the second half of the fiscal. You have steel capacities coming on stream as well. And suddenly you have no big avenue to export because of what the United States has done and the way China is flooding the system. Do you fear that we're getting into a place where, in fact, that growth, that demand growth for steel could come in a bit of a tough spot? Or do you believe the demand is strong enough?
Well, if you see the data, for last 3 years, our domestic consumption has been growing at more than 12%, in fact, at 12.5%. This year, the consumption growth is slightly lower as compared to last 3 years. It is about 8% April to October data. But we expect the growth to increase a bit as it normally does in the second half of the year, because after the festival season, the infrastructure and real estate picks up. Having said that, I will expect that this year it's around 9%, the consumption growth. If we see the export market, you're right, there are challenges, especially in European Union, where CBAM will affect exports as well as the proposed European Union quota changes. That will also affect exports. If we take USA into picture, we did not have much exports to USA anyway. Yeah. So that's not likely to affect us. Overall, the exports will come into challenge, but our expectation is that our domestic consumption itself, we expect it to, even if you take a 8 to 9% growth, it will be around 160 million ton domestic consumption, and our exports last year was only about 4.5 million tons. So exports do not make a large part of our overall production.
Okay.
Having said that,
Yes.
there is a short-term challenge that the capacities are coming faster than the consumption growth, because as you know, the consumption growth, even if it increases it to 9%,
Yes.
it will grow in a sort of a linear manner,
Okay.
while the capacities come in spurts. So we already have a capacity of about 215 million ton. So in short term, there may be some stress on demand-supply ratio, and we may have more supply than the demand for next 3 to 4 years. But I expect that the demand will catch up with supply as we move forward. So to answer your question in last one line, yes, I expect that the demand will continue to rise between 8 to 10%.
Mr. Pondrik, hi, good morning. Prashant here. There is, so let's just, 2025, I guess, has been such a volatile year, right? With tariffs and it's essentially has been very, very difficult to call, so many twists and turns. So as we go into 2026, maybe a lot of these hotspots will cool down. US, China, US, India, hopefully, very soon. And it'll be a more settled kind of a world. Maybe average tariff rates perhaps will be higher when they were where they were at the end of 2024, but more certain in that sense. Let's hope so. Once you have all this settled, do you think, generally speaking, as you said, steel is in India largely a local story. It's not so much from our perspective, a big global story, provided we have that protection, etc., in place. But do you think once all these hotspots are settled and the environment is more certain, it should help in better prices? There's the China involution, anti-involution as well. And things should look much better in 26 over 25? It's a broad question.
Means to say that things should look up in terms of pricing. Yes, I think so, because two things. One, if you see the latest data from World Steel Association, the production of steel in other countries is going down. If you see the latest data, even China, the production in October has decreased significantly. So I would presume that the demand-supply scenario will improve. And the steel prices right now are at quite low level. And as the demand increases in coming months, I would presume that 26 the prices would stabilize from where they are right now, and the steel sector should be, in terms of pricing and in terms of getting realistic or rather reasonable price realization, it should look better. And that is also reflected in the fact that the steel sector is planning and executing capacities, not only in the executing but also in planning. So both is happening, and that sorts of gives focus on this thing, that even the market is looking at the thing that the demand will keep growing.
All right. Mr. Pondrik, and the building blocks have been in place. I think for the last 9 to 10 years, I've been seeing that every time the industry is in a bit of a tizzy, you'll come in there and you'll have helped the industry. And that's why we have a solid domestic ferrous sector, which is standing out in this volatile environment globally. And the point on China, yes, they're producing less. The problem is the exports are continuing at around that 10 million tons odd. Hopefully that cools off, because otherwise it's blocking avenues where we can export as well. But we'll talk about that in greater detail, in the next time around. For the timing, the market will want to know a couple of factors. What about NMDC Steel? Is there going to be a divestment? You said maybe, probably it'll happen. Timeline is not sure. Do you think there has been some movement on that front? And if you could help us out with RINL, how are things progressing out there? The turnaround strategy was in place. Progressing well?
So first, NSL, my answer remains the same. So the decision of divestment stands. The process is going on. There's no fixed time frame of when it will happen. So that's the status for now. Having said that, the plant is doing well. It is reaching almost 100% of its capacity in terms of production. Because of the low steel prices, they are not coming into a lot of profits, but in terms of operational efficiencies, they have improved quite significantly. So divestment, the decision stands when, I can't really say. On the RINL, so as you know, last year this year, in fact, in January, government gave the package. They have used it well. I should say they have used it well from 25% capacity in August 2024. Now they are running at about 80% capacity. Yeah. They should reach 100%, but there are challenges in terms they have never actually ran at 100% for a long time. So they are getting operational challenges, which they are trying to address. But we hope that now the plant is on its way for revival on a sustainable manner, not in a short term. So we expect that RINL will continue to perform well and do well.
Okay, all right, Mr. Pondrik. Always a pleasure, sir, having you on the show. As you're telling us, both those two assets are ramping up well, NMDC Steel as well as RINL. But I'll tell you what, a lot of industry players, as we speak, have already messaged. They are hoping that safeguard duty comes sooner than expected, because they have been waiting, for the past 1 month or so for that notification to come in.
Since we have Mr. Pondrik, absolutely unfair question to you, sir, but you're one of the top bureaucrats in the government. On this India-US trade deal front, you're shaking your head already.
You better talk to my other colleagues who are dealing with it.
Okay.
I won't push you, but thank you very much for joining us, sir. Really appreciate it. And thank you very much. We'll take a quick commercial break here. We have the management of G Shipping joining us on the other side. Stay tuned. Coming up. Okay, welcome back. Markets, of course, not doing very much. We're about three-point change, nothing. But the story, of course, is that basically the fact that we've pulled up quite a bit from the day's lowest point. I think the low was made about 25,900, and we pulled about 60 points, 50, 60 points off the lows. And I think one big reason, of course, is Reliance Industries once again, which seems to be pulling its weight. It's up 1.25% on the day, and of course more from the day's lowest point. So 1554 on RIL. I think majority reason why the market is doing what it is doing. Now, overnight, news flow, and maybe we can put that quote up from Ukrainian President Zelensky, sounding much more open to the idea of settling the war in Russia, and those graphics will come up. This is a US brokered peace plan, and Zelensky not going on the offensive like he has in the past couple of years, saying we're going to fight to the end, and we got support from European countries who've been urging him to continue the fight, etc., etc. Much more conciliatory sounding Ukrainian President Zelensky. Remember, it's a war which has gone on for 3 years now, over 3 years now. G. Shivkumar is Executive Director and CFO at G Shipping. Thanks very much, Mr. Shivkumar. Good to have you with us here. We've discussed this many times in the past. How material is this? Something of a ceasefire coming into effect, if it can happen. I think there is a deadline this week, 27th, which of course seems to have been put in place by President Trump. Go on.
Morning, Prashant, and thanks for having me. Yeah, so we'll await whatever developments happen, and this is of course a fast-changing situation. The first impact of a ceasefire. And we'll have to see what impact it has on the tanker market. So if trade patterns go back to where they were 4 years ago, before the start of the war, then the first impact is a negative for the tanker markets, because we had between a 5 and 10% ton-mile bump as a result of the change in trade patterns. However, then that's a negative for the freight market. So that's a negative for earnings if it happens. However, you'll have to see whether trade patterns actually go back to where they were. And just to remind you, most of the trade was between Russia and Western Europe. So, and Western Europe was heavily dependent on Russian crude oil and Russian refined products, which changed after sanctions came in, so on and so forth in 2022-23. So the question is whether it goes back to the earlier situation, or you have this disruption happening permanently. So that's really, while a ceasefire could happen, and that would be good, we don't know whether the trade patterns will actually go back to where they were in 2021 pre-war. And that's really the critical point for the tanker markets.
So 5 to 10% drop and negative for earnings, basically, immediately, right?
And when I say 5 to 10% drop, that's in ton-mile demand, and the impact on rates would be much, much, much higher. So just to give you an idea, 4 years ago, rates for tankers, whether it's product tankers or crude tankers, were between $10,000 and $15,000 a day. Today, the rate for crude tankers, which is, and let's say the mid and slightly larger size crude tankers, Aframax, Suezmax, are $50,000 a day. Okay, and that's the kind of impact a 5% difference in ton-mile demand can have. However, as I said, the caveat is that is if trade patterns go back to where they were before the war, which is a little unlikely in most analysts' opinions.
Okay. Wow, 10 to 15,000 pre the war starting. This is tanker and product, oil and crude and tanker product rates. Tanker rates basically for oil and product, and now 50,000.
That's right. For crude tankers, product tankers, it's like $30,000 a day.
Wow.
So these little changes on the margin, 2 to 3% also makes a big difference on the margin, because the market is pretty tight. And, once that change happens, then it's anybody's guess what happens to rates.
And you said if the product purchase thing remains, if it goes back, basically, which is Western Europe starts to buy from Russia once again in a big way, only then all this will happen.
Will reverse. Yeah, that's right.
And
then you have the second order impact, which is there's a lot of ships which are actually still here, and the fleet is very old, the shipping tanker fleet. And a lot of the ships are only still carrying cargo, though they are overage, because the market is so hot, because you're making $30,000, $40,000, $50,000 a day. And if the market drops, then the next impact is for a lot of ships to get removed, which then brings the markets back into balance.
Yeah. What happens to, because, the product market has also been very tight, right? I think 7-8 days back, there was that refinery in Russia, which was a major attack. But I think supplies, etc., have resumed from the port nearest to it.
Yeah, but refining margins are very high, especially in Europe. So there is a shortage, especially of diesel. I think even US gasoline inventories are pretty low. So there is a shortage of refined product. So oil is, moving from wherever it's available, even if it's a long way away. So there is, and refining margins, high refining margins, incentivize transportation of crude oil, transportation of refined products. So demand for tankers is really being driven by these refining margins and the amount of oil that's coming into the market, the crude oil which is being pushed into the market by OPEC.
Yeah. What kind of, what can happen if do you have a view, because you're so closely associated here, these exceptionally high, margins, especially on diesel. Mm-hmm. If say there's a ceasefire or something, you think we can, what happens there?
Yeah, so you could have that Russian oil coming back in. You keep having these little disruptions from the attacks, the drone attacks on the Russian refineries, and that's what's taking out this capacity from time to time. We also have some refinery turnarounds happening in the Middle East, which is also resulting in more crude oil being exported out of the Middle East. And again, this happens in a cycle. You'll get those refineries coming back, and maybe you'll get margins coming off again because they're exceptionally high now. We're talking $35, $40 in Europe. So that should probably come down because they are unsustainably high. You can't have them this high for much longer. But the good thing is that it helps the tanker market.
Yeah, and what could be the kind of impact here? I mean, just like you did for the, is there a way to tell?
You mean on the tanker earnings?
No, not tanker. So diesel spot cracks, as you said, $30 a barrel, right? Yeah. What could happen to it? $30, $40, as you said.
Yeah, I'm not sure. It's pretty high already. I don't know how much higher it could go. And again, we're not experts. We just say that, okay, this is high and that's what's driving the market and we enjoy it while.
No. I'm saying they could be, if there is more product into the market and Russian oil is back in the market in a big way, these cracks will compress. That's my point.
That's right.
So
that's right.
Could there be a substantial...
The impact would be that they would come down a little bit. That's right. Come down substantially. Yeah.
Yeah. Okay. Come down substantially. And you would expect all of this to play. Financial markets respond, as you know, quick and fast. But this is, the business of ships and routing and all of that stuff, right? So that takes time. But do you expect all of this? If there's a ceasefire announcement, we wake up to a ceasefire announcement, you think all of this will play out very fast?
First, the EU has to remove sanctions. The EU has to accept it. Then the consumer, so the German consumer, let's say, who was earlier importing a lot of crude oil from Russia, has to go back to importing crude oil from Russia rather than from the US or from Brazil or from West Africa. So all of that has to happen. And this is not as easy as signing a ceasefire or agreeing a ceasefire. So that will take some time. Yeah. That will take a bit of time to play out in the tanker market. Again, sentiment can change, but you need a lot of things to fall in place for trade patterns to go back to where they were before.
Got that. Now, just one last question, Mr. Shivkumar, and this is I'm moving away now from what the bulk of our conversation, actually all the conversation so far, which is this big push to the shipbuilding, make ships, at home here. Actually, a lot of countries are doing it. US is doing it. It is talking about it. What do you make of it? The push. It's.
I think it's good to have a shipbuilding ecosystem, a shipbuilding and ship repair ecosystem. And a shipping ecosystem for that matter. As a large maritime country, we need to have a bigger shipping industry, which includes everything associated with shipping. So to that extent, we welcome it. It'll take time, obviously, to build this up, but you have to start sometime. And hopefully this can get built up into a big contributor. And so we are happy that shipping is on the radar of the government. As a big consumer of freight, as the Indian economy is, it's good to have a shipping fleet, an Indian shipping fleet.
Yeah. No, 100%. It's a critical sector in that sense. And China, by far the leader, right? In terms of the number of ships they make every year. Thank you very much, Mr. Shivkumar. And I hope we don't have to talk in the realm of possibility and soon we can say, well, the war's ended. And there's some semblance of peace in that part of the world. Thank you very much for joining us. Good speaking with you. Well, that's GE Shipping with some perspective on, the likely implications of this ceasefire, which is it's looked lossable many times in the past, but I think closer than ever before. 25,992 is where the Nifty is at. And we're up about 32 points off the lows by quite a bit. We have Chandan Taparia, who's with us, Head of Derivative and Technicals, Wealth Management and Motilal Oswal Financial Services. Chandan, good morning. Good to have you with us here. Quick word on what the price action you're seeing and trades you would recommend?
Yeah, good morning. Thanks for having me. So we have monthly expiry and index got stuck in between the series VWAP and weekly volume weighted average. So as of now, if I look at the series on series basis, Nifty just flattish. But the good part is we have seen put writing at 25,850, and that is also the volume weighted average for the entire month. The only concern is that weekly volume weighted average is at 26,050, and that is not allowing market to move beyond that level. But the good part is that market is trying to absorb the supply near 26,000 marks from last couple of days. So major trend could remain positive. However, we may consolidate today with some volatile swings being the monthly expiry. But overall, I believe till it holds above 25,800, 25,850, index has potential to rally towards 26,100 to its all-time high of 26,277. The good part is that today the India VIX is down by 6%, and that is somehow adding some sort of support-based buying in the market. Now, talking about Bank Nifty index, Bank Nifty outperformed the broader market in this series, and Bank Nifty has comparatively higher base. As of now, it has been supporting or finding the key support at 58,500. So till it holds above the same, we are expecting a positive stance towards 59,250 to 59,500 marks. Now, talking about stock specific idea, our first study is buy on AB Capital. One of the strongest counter, overall longs are being added on series to series basis with positive rollover. In fact, multiple supports are visible near 325, 330 marks. And put writing also visible in the next series. So we are recommending to buy with support of 330, and this counter can head towards 360 kind of level. Second trading idea that is from the auto pack, that is buy on Ashok Leyland. In fact, some short covering is visible in the counter. Consolidation of last 5 to 7 days is getting over. Major trend is positive, respecting well above its rising trend line. Rollovers are beyond 82, 85%, indicates bullish bias. So with support of 144, one can see an upside target towards 158 kind of level. And one more trading idea that will be buy on Nykaa. Strongest price pattern has been consolidating, but every declines are being bought. So with support of 264, we are looking for an upside target towards 285 in the Nykaa.
Thank you very much for that. After a slow start, the Nifty is back at 26,000 and Reliance Industries has been a big contributor. Stock has popped nearly 1%. Get into a break. On the other side, Manisha Gupta will focus on commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha, what are you looking at?
Precious metals, because overnight gains have been quite strong into this one. And after being stuck in a range for gold and silver, both of them, for most part of the last 4 to 6 weeks, we seem to be breaking range on the higher side right now. And this is majorly ahead of the lot of US data that's coming in as well. Today, you have the US retail sales, PPI numbers, home sales, consumer confidence, all of that data and some more is coming in today. And the important numbers that are coming in tomorrow is the US weekly jobless claims number. You have the durable goods data order. It also is about the third quarter GDP numbers and some more data again coming in tomorrow as well. Remember, it's a truncated week for US because of the Thanksgiving holiday there. And ahead of all of this as well, we also are looking at the US December rate cut probability on CME rise to a 79%. This is from 44% in the previous week. And that in turn also seems to be supporting gold and silver prices. There is a bit of a decline that we have seen for the dollar index that has come off its 6-month highs, also supportive. Many of these metals, not just precious, but the base metal prices have gained today because of this as well. Take a look at the gold prices then, and we have seen 2% of an overnight gain come in for this one. And with that, we are trading at around $41.50 an ounce. For the month, we are up by 4% and 58% up for this year. This is perhaps the best yearly gain that gold is heading for since 1979, with 58% of gains. For the Indian markets, the gains stand to around 63%. That is with the rupee depreciation as well. So we are looking at higher gold prices for the Indian consumers there. Take a look at silver, and we've seen 1.5% of gains in the overnight market for this one. It's 10% up for the month of November, and 78% of a return is what silver has given you for this year. And this is for the international markets. For the Indian markets, it is 84% of gains, taking rupee depreciation in. This is the best yearly gain that silver is headed for as well for a decade there. For the international markets, there's a bit of a disparity. And if you look at the premium, COMEX is paying it slightly on the higher side, but because COMEX has a silver inventory of 462 million ounces, while LBM stands and London stands at 844 million ounces. So London is trading cheaper. You have a premium that COMEX is paying and premium that much of the Asian markets are also paying, especially India, where the physical silver investment buying continues to be on the stronger side. And then it's not just about gold and silver. Platinum is up 74% this year. Palladium trading up 59% as well, with markets awaiting all of that data that US has to give in, and that would give you further direction.
Okay, Manisha, thank you very much for that. Well, as commodities in focus, we're going to take a quick commercial break here. Time for our special segment, Market Masters. Lata will be speaking with Harendra Kumar of Elara Capital on second quarter earnings, valuations, and his preferred picks. Stay tuned. Coming up.
Welcome back. Indian equity indexes, large or mid-cap indexes, have delivered only about 6 to 7% returns in calendar 2025. The second quarter earnings of FY26, that is, have not quite been able to trigger a market-wide rally. But are the earnings at least showing signs of bottoming? Elara Capital has just put out a report stating that Nifty EPS rose only 6.8% in the second quarter, and for the full year will deliver only 3% EPS growth. But they expect Nifty EPS to grow by 14% in FY27. Elara also points out that mid-caps have done far better. Now, to get a sense of whether the worst of earnings downgrades is over and which sectors show maximum promise in calendar 2026, I have with me Harendra Kumar, Managing Director Institutional Equities at Elara Capital. Harendra, good morning and thank you very much. We're meeting after a pretty long time on air. Well, first up, that's the question really which is bedeviling the market, confusing investors. Is the worst of earnings over? Are you seeing, a reasonable, steady earnings growth from here on?
Yes, pretty much. I think the good part is that we caught this trend reversal early on before the results in our preview note. And we said that sequentially, the single-digit earnings is going to trough out and you're going to see a rebound in earnings from Q2. So while the Nifty earnings are tepid, our broader Elara Capital company coverage, which is around 300, seen a good PAT growth of 13.5%. And this is largely coming from mid and small, which has surprised even the large caps. So there is a broadening of trend in the earnings, which is clearly being seen from the numbers. Now, this trend is going to become stronger as we progress into the next year.
Okay.
What is driving this is, of course, our rebound in our nominal growth, which will set in. That's the point we're trying to make.
Okay, Harendra, I'm coming to that in just a bit. I mean, that's the most important thing that people want to ask. But this confusion between Nifty and the broader market. Your report says Nifty grew by 6.8% EPS in second quarter, but for the full year, you're expecting only 3%. So Nifty hasn't quite bottomed out, even if the, non-Nifty stocks have?
Yes, if you see, because the calibration is the Nifty is dominated by the financial sector index, which is still seeing a calibration with respect to the NIM margins and the interest rate resets. That will reverse in next year after the deposit pricing, the interest rate and loan pricing gets settled in. That's one very large important point that you'll have to see. Okay. And of course, you will get a reset on the IT earnings as well, which is a significant portion because of the rupee depreciation and the rebound. Okay. So when you have two large market weights moving upwards, you should see a natural growth. And third, of course, you will have the consumer discretionary, which has picked up with the autos and some of the discretionary spends. Will get a continuous fillip going into next year with the pay commission, which is larger than the GST tax cuts or the regular tax cuts that the government gave this year. So all in all, there are multiple triggers for earnings in various sectors to play up.
Okay. No, I take your point on Nifty being kind of weighed down for the current year, even in the second half, by the financials, which I think is about, 35% of the Nifty weight. So that would weigh down. So should one look more at mid-caps? Is that the place where the growth is?
Yeah, absolutely. If you see, where did the mid-caps start to flounder? Mid-caps are, lower down the food chain. Once you tighten liquidity on the large caps, it actually flows down to the mid and small. So when the RBI started tightening, from all sides and the flow down of the correction set in the mid caps. Now, as the liquidity start to ease up, it will start flowing into the profit margins of mid caps and all caps. So clearly that is what is being seen in this current quarter earnings as well. And this trend will continue. And remember, there is this broadening of the market where the mid and small caps are in fact adding more value than large caps because of the availability of capital and productivity gains. So that's where we see higher earnings growth coming up. So in fact, we have put out in a note that our preferred picks are mid caps first, large caps, and then small caps. So if you're looking for hunting to create more alpha for next year, I think you should start looking very aggressively on the mid cap side.
Okay, that's helpful. And that line of yours from your report is flashing as you speak. Let's then concentrate on sectors and stocks. What would your top three sectors be? in terms of earnings growth and even stock price growth?
So first and foremost is, of course, what we've seen is we've spoken on financials. Our financials form around 34% of profit weight, Nifty weight. And it is also heavily FI owned. So what we're seeing is with the return of the earnings for the financial sector, the FIs will also start buying the financial space. And this is quite under-owned, and the valuations are quite converging to whether fair value multiples. If you look at the private banks per se, you're getting larger names at 2.2, 2.1 times. And if growth returns, the multiples should expand. So we see, a good play in private banks at there, given that PSU valuations are kind of converged to private banks. So, if you see what's weighing down the Nifty is the private bank earning re-rating. Pretty much all the three large banks have not delivered anything. Even in fact, the stock prices are pretty much matching the earning growth, or they're trailing the earnings growth.
Okay.
So if the growth comes back, there will be a re-rating there. So that's position.
Yeah.
As rates ease and liquidity eases, NBFCs will outperform the larger ones as well. Okay. So what we're saying is the mid banks and NBFCs and some fintechs in a easing liquidity environment tend to do better.
Okay. Got that. So those would be three of your bets in the financial space in 2026. What outside? I mean, one hears a lot of buzz on power. Several parts of the power cycle have done well. Is that a space you like? It is one of the better performing indexes, energy index in 25.
That's correct. So I think power is viewed as utilities, but I think it should now be seen as a growth sector. Given that as India's manufacturing sectors get a little better aligned, we have now new data centers coming up. The power requirement growth is going to go on an uptick. And if you see the capex announcements coming up with new data centers in Vizag or by other players, it's a given now. Now, along with that, the government is triggering the Nuclear Power Act, right? So it's going to, in the budget session, probably take up the inclusion of private companies to run nuclear power projects, the SMRs. Now, this will lead to a renewed capex cycle as well. So what we're saying is that the power sector capex that had pretty much stalled, for some reason, will get a new cycle, a new breath of life.
Okay.
So that will play up on cap goods, the financiers, the exchanges. So its value chain is as much like auto ancillary. So if you trigger power sector, it works on the economic, different sectors down the
Fair
line.
point. Yeah, fair point. Okay, let me come to, what's the fashion of the day. E-commerce companies, as well as, the recent IPOs. In your list, in large caps, you have Eternal, and in small caps, you have Delivery. Otherwise, I don't see too many of the, newfangled or lately listed IPOs, like, say, Grow. I don't see Lenskart. I don't see a lot of the newly listed ones. You're not still enamored by these new listings?
No, so we have a very basic methodology of how we assess value. We have anchoring value, which is pretty much the net worth of the company. We have short term, and large part of the value of any stock comes from the terminal value. Now, I can give you umpteen examples. So you can say, for example, one asset manager trades at 2,500 crore PAT and a 1 lakh crore market cap, which is around 45, 50 times multiple. And you have a new IPO which is coming at 0 PAT at 1 lakh crore multiple. So the new listed company, we are not against the newly listed company, but it will take years to come to 2,000 or 2,500 crore PAT before the 1 lakh crore market cap is justified.
Okay.
So you could see the time value killing the returns for investors who enter at this price point. Okay. We'll be happy to look at the opportunity at lower multiples. Okay. So that's pretty much the premise. So it's not that they are not great businesses or great entrepreneurs. It's the price at which you want to buy. So in that context, Eternal, if you look at its journey from the IPO, it fell first. Its fortunes turned only after it grew first, which turned into Blinkit and the subsequent re-rating, where the actual TAM and growth opportunity, the terminal value aspect started to play into the price. Right? So we are very cognizant because of the growth aspect in the formula and the ability of the management to deliver the ask rate. Okay. Let me tell you, execution is the most toughest in e-commerce. One leg of growth, whether the terminal value will play up is the point. So we keep taking assessment. So in our case, Eternal has gone through the pain. It's a re-established new model and growing from here. So also delivery. We see a strong turnaround in earnings. It's actually returned to profitability. The new acquisition is a turning point. And from here, it will compound at a steady rate.
Okay. Actually, I'm sorry I'm rushing you because I'm a little disappointed also that, or disappointed as in surprised, that Paytm and PB Fintech are not there in your list of financials. You have Kotak Mahindra Bank. If you can comment on that very quickly, but more importantly, you prefer realty in a big way. You have got both Oberoi and Godrej Properties.
Yeah, I'll start with the realty piece because I'll tell you, in the financialization of India's savings, real estate is a very large piece that people miss out. We all know the mutual fund and the AIF story, but fundamentally, as per capita income goes up globally, be it Japan, be it US, real estate is a large variable. As people go for second homes, luxury homes, we've had, in this from January, we've had 2-3 sharp drawdowns, but actually the pre-sales and the selling has picked up in a big way across all markets. Even the cash flow conversions are very strong. So we see a disparity between the true value and what the market is trading in. So there is an arbitrage. Stocks are closer to NAV and it will compound at a strong rate. So I think there is a dissonance.
That explains, the realty piece. Okay.
And with respect to Paytm and PB Fintech, again, like we said, so the earnings, for some of these fintechs, we love both of them actually, but it's just that in the list of names that we have to put up, maybe some others got more preference over there. Personally, I feel that the AI play is going to work big time on fintechs in reducing the cost to income ratio. So be it what is being announced in Paytm with respect to the AI adoption and the reduction in the cost to income ratio will play up in all NBFCs and fintechs. In fact, we are very cognizant of that, and we actually working with a lot of corporates to figure out how the tailwind will work in their cost to income and adding to the bottom line.
Okay. I think I'll have to invite you yet again for a discussion on that as well. I'm a little intrigued that you have only Kotak Mahindra Bank. The usual list we get is ICICI, HDFC Bank and Axis, but we have to postpone that discussion for another day. More interesting is really how will AI evolve or change the fintechs, and therefore what should we be invested in ahead of the curve? That discussion for another day. Harira, thank you very much for a very interesting conversation. We have to wrap up on Bazaar. On that note, Chartbusters coming.